Hello, and welcome to the next edition of the Capital Stewards podcast. In this episode, we are going to talk about all things Social Security. Is Social Security going bankrupt? How does that impact you? Why should you care about Social Security? For most people, Social Security payments make up a substantial portion of their retirement income after paying into the program over all of those years while they work. For higher net worth individuals that have other assets, the maximum Social Security payout at full retirement age, if you just go from retirement age to age 80, is more than $750,000. So, regardless of your situation, Social Security represents a significant economic value during your retirement. And as we move into political silly season, Social Security is going to become even more of a political hot potato. Undoubtedly, one side's going to accuse the other of pushing grandma off a cliff. Conversely, the other side will suggest back that they're driving the program into bankruptcy. Social Security garners a lot of hot takes. Not all of them are correct. So, our goal in this episode is to lay out how Social Security works, where the program is likely headed, and what that means for participants both now and into the future. And then lastly, we'll talk about how you should plan for Social Security regardless of your income level. All right, so first things first, when we talk about Social Security, it does not work like your 401k. When you save, you accumulate enough assets to hopefully live off of the earnings and maybe a little bit of the principal, but to live mostly off the earnings and the interest on your assets down the road. There are not enough assets in the Social Security Trust Fund to pay benefits based on the interest that's received from the assets. The total value of the trust fund is about $2.8 trillion. Even at today's really high interest rates near 5%, the trust fund itself can only produce income around $140 billion. That would only cover about 10% of the benefit payouts from last year in 2023. Social Security is an income transfer program. What do we mean by that? Well, in 2023, Social Security received $1.35 trillion from payroll taxes. So that line item called OASDI that's on your payroll check that you get every couple of weeks or once a month, however you get paid. They received $1.35 trillion and they paid out $1.39 trillion in benefits. So they take the revenue and they pay it to the recipients of Social Security. However, what they paid out, 1.39, is bigger than 1.35. That means there's a $41 billion gap. And that trust fund that we talked about covers the gap between the taxes that were received and the benefits that were paid. Now, the total value of the trust fund, like I mentioned, is $2.8 trillion. For the last several years, the tax receipts have not covered the required Social Security benefit payments. So the government has been dipping into the trust fund to make those payments, and that's how the program is set up to work. However, the trust fund is expected to run out of money. And you may have heard that before. You may have seen that in sort of the news or some political talking points. But where do those stats come from and are they real? Those statistics come from the trustees report directly from the Social Security Administration. So you can see here, we're going to show some of the main sort of conclusions from this past year's report, and they go through all of the actuarial assumptions and returns and all kinds of things, just like other pension funds and insurance companies, to build these projections. But their conclusions are that they're going to run out of money in the middle of the 2030s. Will the future play out exactly to the year that they forecast? No. Actuarial forecasts are very good, but just like any other forecast, they're forecasts and they can be wrong. But they're the best view that we have of all of the interrelated data points that make up both the contributions to Social Security and the benefit payments from the program. Actuarial science is generally very good. The evidence of that is that most insurance companies that use actuarial science, which is just trying to figure out how much we're going to have to pay out, what our liabilities are going to be versus how much we're going to get in revenue and how much we're going to earn on our investments, right? It's just the math of making those two things work. Insurance companies make money every year, right? We've figured out just general things about the economy, how people work, life expectancies, all those kinds of things. And so we're pretty good at projecting this kind of stuff. But if you say, hey, I'm not sure if I believe the Social Security Administration, the Congressional Budget Office does their own independent analysis of Social Security. And you can see in this chart, for those of you that are looking online, you can see several years ago that benefit payments started to exceed the revenue that was coming in from the program, right? As baby boomers retired, more and more of them retired, and birth rates in the U.S. fell. We're just simply not paying in as much to the program as we're paying out. And the results from the CBO's projection are even more draconian. The trust fund runs out a little bit earlier in the early 2030s instead of making it all the way to 2035. You can see that in the projection here. So regardless of your economic views and assumptions, the data shows that the current program is not on a sustainable path, and something's going to have to change in order for Social Security to be sustainable long term. And that change is going to impact you. Regardless of your politics, it doesn't matter whether you're a Democrat or Republican, where you sit on the side of the aisle. There's only four things that can happen to make Social Security sort of sustainable beyond the mid 2030s when the current trust fund runs out. The first one is that economic growth and payroll taxes are significantly above trend for many years. That means that the payments, if you will, the taxes that are going into Social Security are a lot higher. And you may say, well, that's really great. That means that people are making more money, the economy's doing really well. But that probably leads to higher wages, right? And that's where those payroll taxes come from. They're a percent of your paycheck every couple of weeks. But that probably also results in higher inflation if the economy is really running super hot. And so that means that yes, your payments into Social Security are higher, your paychecks are larger, but you're spending all of that extra money at the grocery store, not dissimilar to the experience we've all had over the last couple of years. And so you're actually probably not any better off in that scenario. You just have sort of more money going into Social Security. Social Security benefits could get reduced. That's the second of our four options. We could just reduce benefits to align them with the payroll taxes that come in. Obviously, that one has politically very challenging. I don't expect that's going to happen in a significant way, but that is an option, right? Taxes could be increased to fund benefit payouts. So we could increase taxes to fund benefit payouts. So again, the money's got to come from somewhere. So it could come from other folks to pay taxes. Or lastly, the fourth option, the government could just change the law and they borrow an extra $300 billion or so each year to fund the program. That also, just like kind of option one, sounds like, well, let's just borrow more money. We already borrow a lot of money today. Probably results in higher interest rates and other challenging things for the U.S. economy over the long term. There's no free lunch, right? So just simply sort of borrowing money, just like, if you borrow money for your business or for your house or on a credit card or whatever, eventually that bill's going to come due, right? So just simply borrowing more and more money into the future is probably not an economically wise thing to do either. So we've got a challenge, and one of those things has to be true in order to solve it. And from my perspective, it's probably some combination of Social Security benefits going down and taxes being increased to fund the program. And it's probably looking at folks that are in the out years. So if you're in your 30s or your 40s now, it's probably some combination of those things that will make Social Security work for the 2050s and 2060s and so on as we continue to move along. So is Social Security going bankrupt? Not in the traditional sense. Social Security won't go bankrupt because if nothing happens between now and 2035, the current law just says we're going to make the benefits lower and bring those payments in line with the tax receipts that we have. And so that's where you hear these things about 20% reductions in benefits in 1 year, because that's about what it would take when we get into the mid 2030s in the current projections to make the revenue that come into the program equal to the benefit payout. So you just reduce the benefits. The program doesn't go bankrupt, but everyone's benefits get a dramatic haircut if we don't do anything about it between now and then. Your politics might dictate what your preferred solution is to the shortfalls in the program, right? You can either raise taxes or you can reduce benefits, right? It's just math. And I think different people can have good viewpoints on sort of which end of the spectrum the sort of change should come from. But all of those outcomes impose a tax on you in some way. Benefits are going to go down, taxes are going to go up, inflation is going to be higher. So when you think about planning around Social Security, and that's where I want to lead us to, that means we've got to be really conservative about how we think about Social Security impacting our financial situation when we get past 2030, 2035, and over the long term. So the first thing to do is when you think about how Social Security and the state of the program is going to impact your situation, the first thing to do is to take a conservative approach to your long-term planning around Social Security. I think given the state of the program, relying heavily on current benefit levels seems pretty irrational, right? If you're just saying, hey, I'm just going to get the plan benefits today off into the future, and I'm going to rely on that for a substantial portion of my retirement, that seems not a wise thing to do. If you're younger, I think assuming that your benefits will be reduced significantly or your taxes will be higher makes a lot of sense. So either of those outcomes mean you need to save more now of a smaller amount of future income in order to make your longer term financial picture work out. If you're in your 50s, I think all the realistic political situations seem to protect benefits for everybody except the very highest income earners. So So I think it's likely that your sort of benefits will be as they're projected today. But that money has to come from somewhere, and I think that probably comes through higher taxes. And so if you're in a higher tax bracket, I think it makes sense to incorporate strategies into your plan that reduce your potential tax burden over time. So things like Roth conversions, charitable giving strategies, real estate ownership, and other strategies that result in you paying taxes today, but then having tax-free income down the road, so that as taxes go up to pay for those future benefit payments, you've already paid taxes and you're not subject to that. So I think it's worth thinking about strategies that sort of shift your tax burden to today as opposed to kicking that can down the road. And then lastly, I always close Social Security conversations with a word on the timing of Social Security distributions. One of the most common questions that we get from clients is sort of, when should I take Social Security? Should I do it at 62 or at 65 or full retirement age at 67 or into my 70s? When should I take Social Security? And the answer is different for everyone. But one of the big myths is that everyone is better off by delaying benefit payments as long as possible. It is true that if you delay payments, your monthly payments from Social Security are going to maximize the value that you receive from the program. So for some people, delaying receiving Social Security until 70 is a really great strategy. However, if you don't live into your mid 80s, you might not break even on the decision to delay benefits in your 60s and receive those later on. So you've got to think about your life expectancy there. And additionally, if you're delaying benefits, and in order to do that, you're withdrawing significant dollars from like a 401k or a traditional IRA, as opposed to receiving those benefits, you really should talk with a tax planner or with an advisor. The compound effect of paying those taxes and reducing the growth in your portfolio might make you actually worse off than if you had just taken benefits earlier. So the math on that depends on your specific situation, the types of accounts that you have, your tax situation. It's very unique and it changes from person to person. So don't fall into the trap of just sort of assuming that delaying Social Security is the right action for you. So in conclusion, a couple of things. Social Security is not going to go bankrupt anytime soon, but changes are going to have to come to the program. And the most likely analysis of that is that those changes are going to have to come in the 2030s. And I think the best way for us to think about those changes as investors and citizens in the US is that in some way our tax burden is going to go up, whether benefits go down a little bit, our taxes go to pay for those things. The result of any sort of change to the program is going to be that there's a higher burden on us. And so we should be saving more to prepare for what might change in the 2030s. So I hope this was helpful to set some realistic framing and perspective around what's actually happening in Social Security. And, maybe it'll help you stay away from some of the scare tactics that are probably going to come as we move into the political season later this year. So I don't think anybody has to be afraid, but I do think you should be sort of sober-minded and thoughtful in how you plan for Social Security going forward. So if you have questions about Social Security, obviously reach out. Happy to have more conversations about Social Security and how that impacts your financial planning down the road. All right, we'll talk to you in the next episode.